Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. It's Tuesday. We are back. We are talking more real estate. I am Barry Saywitz, president of the Saywitz Company and managing partner of Saywitz Properties. And I want to wish everybody a happy post-Memorial Day weekend. I hope everyone enjoyed the day off and shaking off the cobwebs and getting back to work. We thought we'd dive right in and talk a little real estate. I'm excited about today's show because we've been trying to do and wanting to do a show on the medical office sector and medical office space. And so we're finally getting to do it. I'm excited to have our guest with us today, Rob Lee with Healthcare Property Advisors, who is a national healthcare investor, owner, manager, developer, all the above, based here in Brea and Orange County, California. Rob, welcome to the show.
Thank you very much, Barry.
Yeah, so I appreciate you coming on, and we've got you on Zoom this morning, so our viewers will see the split screen. Rob slept in, and I've got to run off to other stuff, so we're gonna go with the Zoom version of this thing. But I do want to start with, I guess, talking about. I mean, you are a local California guy, went to school here, and I guess I want to rewind for a minute and talk about how you got into the real estate business in the first place once upon a time.
Long time ago, yes. So I moved out here, out of college in 1997 and got started a company with some friends, a t-shirt company of all things. And a couple years later, IBM Lexmark gave a handful of people, who were looking to work for a big company, an opportunity to move anywhere in the U.S. They gave me three options. Newport Beach was one of my three, and I got it. Moved out here in September of 99, and then 2 years after doing that, I just had a passion for real estate, had been tinkering with some duplex development in Kentucky, where I'm from, Lexington, Kentucky, and moved here to the Manhattan Beach area, and then got my broker's license and started with Sperry Van Ness, and Rand Sperry and Mark Van Ness were great mentors out of the gates, and really fueled the passion for being in the real estate business.
Yeah, that's interesting. And so I know both Rand and Mark, and we've had Rand on the show previously, and so he's still alive and kicking and doing well and traveling around. And so 2001, I mean, if I remember 2001, it was right about the time there was a dip in the market, wasn't it? I mean, it kind of, I started in 1989 in October, market tanked in November. And as I recall, 2001 was a good time to get into real estate and then ride the next wave up.
Yeah, I think so. I mean, I don't know whether it was, 2001 is right when I, started focusing full time on it. Just realized the big corporate thing wasn't for me. And we had opened an office in Long Beach, and I was focused on selling apartment buildings, and it was scary, right? 13 months or 15 months, I think, before I, sold the first deal. So living pretty lean and mean and paying the mortgage in the meanwhile. So it was a weird time. It was definitely the dot bomb time. So it was a good time to exit technology for me and go into the real estate side. And yeah, I think, the next 4 or 5 years is very good, obviously, until kind of that 07, 08 period where we had a big hit for half a decade.
And then how did you get from the real estate brokerage side of things into the financing and the banking and the equity side?
Yeah, interesting question. So entered real estate in 01 with Sperry Van Ness, started the MBA process in 2003, and I was graduating in 2006 from Pepperdine, and had an opportunity to go work for CBRE or Colliers, and the guy that hired us was leaving CBRE, going to Colliers. So me and about 18 people from CBRE went over to Colliers out of Torrance and started their private capital advisory market. And then a couple of years later, when the market crashed and we had listings and weren't selling anything, I just decided I wanted to go do real estate on my own. And the best way to do that was to go help other operators raise money. And I had at that point developed, a handful of duplexes back home and really got the real estate bug, if you will. And started helping a group out of Orange County, California, the Bascom Group, Jerry Fink and Dave Kim, great guys. also great mentors. They helped them raise some money on a few deals. Really, honestly, just kind of backed into it. I didn't even know what private equity was coming from Kentucky, but just raising money from high net worths and or building up Rolodex of private equity funds. Started my own company, SIG Equity Partners, and did that until about 2012, 13. Had built a nice Rolodex and raised money for multiple groups and got my securities licenses in 08, 09 with a group out of Dallas, a big developer, to help them raise money. And then went to work as a junior partner with a group called Silver Portal Capital out of San Diego. The mentor there, the main partner, was very experienced real estate investment banker who had taken quite a few REITs, public and private. And we raised a lot of money while I was there. A small lean and mean team. Moved to San Diego for about 5 years down in San Diego, great area, and just really got the bug for raising money, and then eventually realized I should be raising money for myself versus other people. And that's how I made the transition with this group. We can talk more about that over to the healthcare side.
Yeah. So at some point, I mean, you got the brokerage side, you got the private equity side, and then all of a sudden you find yourself in the medical sector, using those skills, but I guess focusing specifically on medical uses, medical offices, et cetera.
Right.
So the medical sector is a different animal. I mean, a lot of people talk, we've had a lot of guests on the show talking about the industrial market and how hot it is. And, that's the darling of everything, and the vacancy is super low. Then we've had other folks come on the show and talk about the office market and how it struggled from COVID and continues to sort of struggle along, and all while it's getting better, seems to be at the bottom of the rung of desirability. Medical, you don't hear a lot about. I mean, I love medical space, and I own some medical space, and we're converting office space into medical because the rents are so much higher than office space. And while there's a barrier to entry in terms of the improvements, if you have, in my opinion, I'm curious yours, you have a captured tenant who has to be there and has very few options at the end of the day. And so if you position the asset right, then you should be doing pretty well in the long term. And so I'm just curious how and why the focus on the medical sector.
Yeah, sure. Well, being exposed to a lot of different product types, if you will, right? Retail, office, development, industrial, storage. I just learned over that decade or so of raising money for others that the niche product spaces, i.e. self-storage and senior housing and healthcare and anything that was, mobile home parks, even anything that was very niche had less competition. And, I just had decided I'm going to hone in and look for a self-storage operator or a healthcare operator or affordable housing operator and go meet with them and then find a group who needed my skill sets, which was raising capital and sourcing deals. And at the same time, this company was recruiting for somebody to help them raise their first fund, the growth fund. And we linked up. Honestly, I thought I would be here for a couple of years and go off onto something else just because I'm very entrepreneurial, and this ended up being a great fit, transitioning to the GP side. And, we've had a lot of success together over the last 8 years and love the space. And frankly, just wanted to come here and learn from, Twee Turner and James McGrade, who have a lot of history in medical office and have worked, built an amazing portfolio over time. And like exactly what you're saying, I was amazed at the rents, the triple net nature of the rents, the purpose-built space, how sticky the tenant is, how great the investment grade credit rating is. A lot of these tenants are, and it's just growing so fast, right? With 12,000 people a day turning 65 between now and 2030, it's like the winds at our back. It's just about finding the right space, having diligent, disciplined underwriting, and it's a significant portion of Americans' GDP, right? So it's a great niche.
And really prevalent here in Southern California in particular. I know you guys do stuff all over the country, so everybody needs doctors and specialists, right, and all of that. But really in Southern California, where the real estate is so expensive, the barrier to entry is so difficult. and yet there is a huge desire for specific medical space, especially hospital adjacent. And so you have all these new hospitals that have gotten built or expanded. You have the new UCI hospital that's getting built in Irvine. You have
Beautiful. Yes.
Mission Viejo, Chalk, all of them, right? And they're all busting at the seams. And even Hogue, who wound up buying all the buildings around them in Newport Beach because they had no more room to grow. And so, those to me just tell the story that long term, medical is here to stay. And I agree with you. You've got a niche and you've got a lot less competition. And I guess let's talk about, the business model for HPA. As I understand it, and I'd like to hear your explanation of it, but you guys are raising money, going out and buying medical assets, and then either repositioning them, expanding them, stabilizing them, and then putting them in a portfolio of properties that you own to either keep or sell at the end of the day. Did I miss it?
Yeah, no, that's exactly right. So we have a fund. It's basically a perpetual fund, 50-year life duration, very low cost of capital. I think what makes us unique is the limited partners or the investors in that fund are healthcare systems. Roughly 7 healthcare systems that are, basically owners of our larger parent company, the Innovation Institute. And through those healthcare systems, we've created a fund and created a very nice return for them over the years. And we're hoping that, they re-up as we do, another series of funds. But what's unique about moving forward is we're opening up the investment platform to accredited investors. We're probably not going to do that through crowdfunding and, places to go get smaller checks. Most of our deals are 20 to 40 million on average. Some of them, like one I'm sitting in, the one we did in 2022 is $80 million deal, right? So that's hard unless you really have a money raising machine. So on our moving forward with a new company we launched, HPA Exchange, that'll be focused on the broker dealer and RA network, raising money via 506 Reg DC. So able to go raise high net worth money, but with a very focused 1031 exchange product, DST, Delaware Statutory Trust. And then we also will create our second series, third series, fourth round of funds, smaller funds, 25 to $50 million funds, where that'll open up the investment opportunity to accrediteds through the RA and broker dealer network.
And so, so for those folks out there who are the layman, right? So if you sell a property, and you're going to do an exchange, if you don't do an exchange, you'll have to pay tax, right? So a lot of people do what's called a 1031 exchange so that they can avoid the tax consequence. And you either have to buy some other, I don't want to say similar property, but you have to buy another property of equal or greater value. And the alternative is, what if I don't want to buy another property and I don't want to go back in the game? I can invest in a DST or a Delaware Statutory Trust, where I can basically transfer my equity and the money that I've made from selling my property into a professional company who has an umbrella, who will then take my money and invest it for me into other assets. And then I hopefully just sit around and get a check. And so that is an alternative to, and great for people who are retiring and who just don't want the headache of managing or the risk of owning properties solely themselves all over again. And it's been very successful. I'm very familiar with it. And so will it be a combination of those kinds of things and then still go back and for lack of a better word, hit up your existing investors who have who it sounds like have done very well and you've shown them the success and shouldn't be a difficult decision to go again?
Yeah, absolutely. So we look at our business as a three-legged stool, right? We have we always entertain private equity, the bigger names, household name, the BlackRocks, the Carlyles. We always will entertain those type of investors, Invescos, on larger deals like this Brea transaction, which is a long-term redevelopment play. That's one leg. We can do GPLP deals there on a programmatic basis. We have the private capital markets, the broker-dealer RA network, which we're just launching, which is exciting, which is the business I come from. And, thankfully have had a lot of success and I'm really excited about that. It's very expensive to develop those channels, but we're committed to it long term. And then the third is just, additional funds, discretionary institutional funds. So we think, the lifeblood of real estate, as well, is capital. So we're looking to diversify those and really, plant roots into this private capital markets because look, just like us, right? Just like even, just like ordinary person, doctors and physicians are also aging. So a lot of physician groups have real estate where they want to monetize it. The healthcare system might not have interest in buying the real estate. They want to keep their money free for operations, but they want to retain or capture those doctors for the long term. They call it the foundation model. So it's kind of a win-win for everybody. If that physician group or the healthcare system monetizes the real estate, we do a sell lease back. They can contribute the real estate to our fund or our future funds via 721 exchange, which allows them to take some combination of cash and or op units. And then we really view the DST and our funds as estate planning mechanisms, right? So if you're a 70-year-old doctor or a 50-year-old doctor, doesn't matter the age, and you sell your real estate, you want some cash out or you want to exchange it, the beauty of the 1031 is if you wait long enough, your kids or your family can inherit real estate with a stepped-up basis, or you can continue to what they call swap till you drop, right? Just keep exchanging. It's just an amazing wealth accumulation generator.
No question. And doctors typically, I mean, the MO is I buy the real estate so I don't have to pay somebody rent. One day I wake up and I realize, gee, I'd like to retire. So I find either a junior partner or doctor, or I find somebody to take over or purchase the practice. And then the junior person a lot of times doesn't necessarily have the wealth or the wherewithal to not only buy the practice, but then also the real estate. So as the doctor exit strategy, you either keep the real estate and become the landlord, or as you say, try and convert the equity in the building into some other form or fashion where you can invest it or watch it grow. And so there's no question that that is prevalent out there. And then all the doctors that we talk to on the smaller building purchases, the MO is just I don't want to pay rent to somebody else. And so I mean I think that's a good segue into the rental market, because the rental market really dictates the success of your investments at the end of the day, right? It's a cap rate, it's a value add, it's a valuation of the property. And I guess let's talk about what medical rents have done over the last 5 years, and certainly since COVID, with very limited new construction, you really have a run up of demand for medical space, which has caused a run up in the rents.
Yeah, and I would say, with that also comes a rise up in cost, right? So, take for example this campus here that we're redeveloping now. We're parcelizing 4 buildings. The front building, is a large 100,000 square foot medical office building. To go, the healthcare systems have to put or the physician groups, whoever the user is, has to put so much money into their space to, bring it up to where it needs to be to perform whatever specialty outpatient practice they have, right? Whether it's orthopedic or whether it's primary, we focus on clinical space, which means exam rooms, purpose built, imaging equipment,
heavy electrical, heavy plumbing,
yes, exactly.
Heavy cabinetry, lots and lots of extras, right? Versus just building walls and air conditioning.
Yeah, and look, and the whole model's changed, right? It's not the traditional, 40 doctors in small practices, like your typical dentist would be in a building with a bunch of other tenants. Users are taking larger floor plates because they have because there's so much demand and so many clients and there's so little space, right? There hasn't the supply has not kept up with the demand over the last 20 years in the healthcare market. And frankly, it's very hard for them to, for there to be enough space available. So, we're putting a, surgery center, a GI surgery center, 2 operating room surgery center in the front building here as a credit union exits the space, right? And it's the cost to build this stuff out is $700-800 a foot sometimes, depending on how intensive, the equipment is.
And so let me ask the question,
Sure.
because you're throwing, first of all, the tenant would never throw that kind of money at it on their own. I mean, I don't want to say never, because they would, but it would have to be a very large, well-heeled organization. A group of doctors
Right.
would never, number one, have that kind of money, and then number two, no bank would loan them that kind of money because there's no return. And then even if they did, at today's interest rates, it's very expensive. And then you've got to personally guarantee the loan. So certainly, if you guys have the capacity and the capital to be able to do it, you do it, and then somebody rents it from you. But then at some point, you got to get your return back on your investment, right? So then that goes back into the rental rate, whether that's a market rate, or I'm going to suggest in your case, you just made up a rental rate that it took to pencil the deal, because there's nothing to compare it to. You're just comparing it to your costs.
Yeah, well, so we'd love to be able to make up the rate. We still have to look at what ultimately, if and when we sell the property to an institutional buyer, who's typically the buyer of our products as we sell it, right? The LaSalle's of the world, the large private equity funds, the rental rate still has to be justified with the market rate. We always push those limits, but we're not charging the most rent possible so we can get the most return possible. It really is a function of that build out. And we'll typically contribute, a range depending on the overall math, call it 50 to 200 a foot, depending on the use, to the deal. But the user almost always is putting in additional funds, and that's good for us. It's good for them. It shows commitment to the space. Typically doing a 7 to 10 year lease plus with options. Typically, if it's a gross or base year type lease, converting it to triple net. Most medical leases are triple net. So we're, and every market's different, right? Texas, we might see $21 annually per square foot, and then here in Orange County, $3 to $4 per month triple net per square foot. So it really depends on where you're at. But ultimately, it is a formula where you're backing into a return, and if it's a long-term core plus deal with investment grade credit, you're going to be in the low teens IRR. And if you're going to be a value add, taking a lot of risk, a lot of lease up, heavy lifting, it's going to be a high teens plus type of return over a 5-year horizon.
Which, when you compare that to a T-bill or a bond or the stock market, it's a pretty healthy return.
That's right.
And hopefully you've got a credit tenant that reduces or minimizes the risk of them, defaulting on the lease, so that you feel comfortable you're going to get your rent at the end of the day versus buying stocks and wondering what happens from one day to the next.
That's right. Plus, you get a lot of tax benefits, right, through cost segregation and appreciation. So that's the beauty of real estate.
Absolutely. And so we just did a show on that not too long ago. And so for those viewers and listeners out there, that is a very good example of plunking a large chunk of investment money into an asset and then being able to accelerate the depreciation, which makes the return even better, I think. And,
right.
and so, which is funny because I have a meeting with my accountants today and we're talking about that exact same thing. So it's a warm up. But so in terms of the medical, I mean, there really is, I'm just going to use Southern California as a whole, but I mean, you look at office rents, and I'm going to ballpark it because they range from one submarket to the next, but I mean, $2.50 to $3, $3.25 full service. And then you look at medical rents, which again are all over the board, but really, as you say, $3 to $4 to $4.50 triple net. And the triple net charges typically would run, I'm curious in your buildings, but on a medical building, you would think they'd be another 80 cents to $1 plus a square foot on top of the rent.
Yeah, $1 to $1.50.
Yeah. And so you're really looking at, you could be $6 a foot modified gross, and then you have to pay your utility bills on top of it. I mean, it's a healthy cost on a per square foot basis. But the difference, I think, is when comparing the office space to the medical space is you have lots of other office options and a much deeper basis to be able to say, well, the market this or the market that. In some instances, you have very limited competition in a particular submarket close to a hospital or close to a bunch of retail. And so it's a lot more difficult to say, hey, well, the market's this, or, I can move down the street. Doctors can't typically do that.
No, that's right. And it's a longer term horizon too, right? It's not what's the best deal for us this month. It's really the proximity and the whole. I mean, just since I entered the healthcare piece in 2016, it has changed dramatically. It went from, we always viewed the hospital as the castle, and then we looked for the moat around the castle. We only bought real estate on the moat, like at Mission Hospital down in Mission Viejo. We had 4 MOBs there, right on the campus, amazing location. But that model has really changed to a spoke and hub, right? Imagine a bicycle wheel. The hub is still the hospital, the acute care hospital, that huge behemoth hospital that you really don't want to go to unless you're really sick, right? Very expensive, very big, very institutional. Then all those spokes are areas where you can put a ton of different types of real estate, right? Urgent cares, specialty groups, inpatient rehabilitation, senior housing, you name it. And ultimately, the tire around that bicycle wheel are the neighborhoods. So those spokes are where all the real estate's moving, and hospitals do it because they want their brand out in the neighborhoods for market share. Even though they're not for profit for the most part, they're still very kind of Fortune 500 minded when it comes to market share. It's all about population health, and now it's really expanded it. And you've seen it in your neighborhood, and everybody in the U.S. has, where used to be you had to go to the hospital and the MOB was next to it. But now you go to Target, you look across the street, and there's a primary health care, right?
Yeah.
So the mom or the dad who takes their kid to soccer can pop in if Susie has a head injury or butt knee. And that's, you want to go there because you're getting usually inpatient. You're usually getting a hospital type of reimbursement if you're the hospital because your name's on the door, or if you're in a JV with another brand, right, like United and Optum and groups like that. But you're also closer to where your patients or customers live. It's a nicer, better experience for the patient because you got a flat screen TV and a nice waiting room, and it's all about time, right? You're in and out so much faster than going to the big hospital sitting next to the person with the head wound, right?
And I found too that a lot of these specialists that get referrals back and forth from the hospital, they want to be close, right? And so they want to have that affiliation. They want to say that to their patients and give them a comfort level. And so I mean, I don't disagree with you at all. I think that the real estate around the hospitals is very valuable long term and becomes more valuable over time just because that spoke, as you mentioned. If you're further out on the spoke, the real estate theoretically, it's just further for somebody to drive, and so. So I guess, what do you feel is the prognosis for the medical sector as you look at the real estate market today? I mean, obviously run up in interest rates. Everybody says, oh, interest rates are going to come down. You should buy this property and then you can refinance it in a year and rates will be less. And I'm just not feeling that. I mean, I feel like the deal has to pencil on its own in today's world. I'm not going to buy future return, maybe a little bit, but not to the nth degree. And so what do you feel is the horizon and what's the game plan for you guys?
Yeah, sure. Well, I mean, I think it depends on it all comes back to cost of capital, right? And hold duration. If you're a family office and, we try to go after some of those buildings around Hogue and, some of those traded in the 3 cap range. And that's great if you're just a wealthy family or an institution just trying to move the needle a little bit, get a 7 or 8% unlevered return over a long period of time. But we are, we're in the business of making our investors money and earning a good return and a track record. And for us, we have a dual strategy, a barbell approach, right? One end of the barbell is growth and income, which is really your value add properties that have significant rent growth over time, or we're adding a lot of value through reconstructing it, bringing it up to code, doing these larger floor plates, et cetera. And then the income is really why we're getting into the broker-dealer RIA market, because there's just a lot of people that are retiring and wanting that fixed income, and that's a great safe place relatively for their long-term retirement. And I mean, if you just look at the demographics, Barry, right? Like 1950, I think there was something like 12 or 13 million people that were 65 years or older, and then by 2040, there's going to be 80 million, right? That's 12,000 people a day between now and 2030, as I mentioned, turning 65 years old. It's crazy. It's 18-19% of our gross domestic product. And there's so little space in every office building. Even though most brokers, and I'm a broker. I love brokers. It's most of my best friends, right? And we do a lot of business with brokers. But every office building doesn't work as a medical office building.
Right, that's true.
Like every office building doesn't work as an apartment building. But there's a lot to go into it. Plumbing, electrical. I mean, we have to put a whole fire envelope around these surgery centers we're building, which is very expensive to encase it for fire protection. And we looked at properties, and we're still looking at properties over by the new UC Irvine development. We love that area. We love Irvine. We love Orange County. But it's parking's an issue, right?
Oh yeah.
We found a perfect office building over there, but it would cost us $14 million to build a parking garage to get the 5-to-1 ratio. So ultimately, it all becomes a function of price. And like you said, I think there's still a significant bid-ask gap right now.
I agree. And I think you've got, and look, I'm a broker as well and have a brokerage company, but you've got the broker trying to sell a deal to anybody and pitching whatever they want. And a lot of those dynamics just don't really hunt for an investor. At the end of the day, you need to find somebody in an exchange or just a private wealthy person who, doesn't really care, I guess, at the end of the day. But yeah, buying something at a 3 cap and eking out a 5% return at the end of the day doesn't hunt when you're trying to prove yourself to other folks, and when you can get 5% by doing nothing in the bank today, at least. And so therein lies the dilemma. But I agree with your point. I mean, the parking is a huge issue, not to mention the zoning with the city. And so then even if the city wants it, they throw the book at you in terms of the upgrades and the fire life safety and the code upgrades and the sprinklers and the lighting, and then you got to go figure out the parking. And so I just think long term, buildings that are already zoned for medical, that have the infrastructure in place where you don't have a problem getting the medical use per se, it's just a question of fitting out the space itself, become that much more valuable over time.
Agreed. 100%.
So let's talk about interest rates for a second. We got a few minutes left. I always say it goes quick, and then it does. But in terms of interest rates, I mean, nobody's got a crystal ball, but do you believe, and is there talk among your office that, hey, rates will come down between now and the first quarter of next year? And does it do anything to the market or the lending environment or that gap we were talking about between buyer and seller? I mean, what are your thoughts?
I mean, I hope they do. I mean, we're in contract on the deal right now, right? I think the 5-year treasury today, which is, 5-year for the most part is kind of what we look at. I think it's 4.5, 4.52. It's fluctuated already this morning, quite a bit. A couple weeks ago, it was down at 4.3, 4.2, right? It's moving. It's so volatile. So so I hope they come down. I don't personally think that they will. I think it's going to be higher for longer. I think we're probably looking at next summer or the fall. The election here could change it. Who knows? We could get an artificial dip to help people vote. I don't know. I mean, it will help us. Obviously, real estate's a capital-intensive business. We hope it comes down, but I don't think we're going to see the crazy low rates we saw before, right? So I think it's this time period, transaction volume roughly down 70% in MOB space. It's going to take a little while for sellers to realize 5.5 cap doesn't work when you have a 6.75, 7% loan, right? And there's tools. I mean, this deal we're buying right now in Arizona Micro Hospital, we'll buy the rate down, which costs a lot of money, right? And then we'll put a hedge on it to kind of control that volatility. All these tools cost money, which has to be baked into the deal and the return ultimately.
Yeah, I still think the inverse relationship, as you mentioned, between the cap rate and the interest rate, it doesn't haunt, right? I mean,
but you know what? It's amazing that we're still seeing deals.
Right? You still see deals go, and then I shake my head and go, I don't know what that guy was thinking, right? But
the real question is, let's see where they're at in 3 years, right?
Right. I mean, I'd like to talk. Right, you got to make a list of those guys because hopefully those are the people you want to talk to, or the guy who had 3.5% interest rate and it's getting ready to roll, and it doesn't matter where rates are at, he's never going to see 3.5 again. And if 3.5 goes to 6.5, your mortgage doubled, and then some. So those will be interesting plays, I think, as time goes forward. But I agree with you. I don't think that even if rates came down 0.5 point, while it might help some people on the residential side a little bit, get it going a little more, it doesn't really help on the commercial side to move the needle enough to make a difference.
I mean, every little bit helps, but it's ultimately the market, the sellers have to just realize that negative leverage is a bad thing, and we can only buy what we can get debt on because nobody's writing a check unless you're a large, sovereign wealth fund or a pension fund. Most people aren't buying a deal all cash and holding it long cash long term. So it has to be positive leverage, and there's different ways to get there, but there definitely is a little bit of normalizing that still has to happen.
I agree. Then let's talk about labor real quick. How does that impact these tenant improvements? I mean, labor costs up. I think it's flattened a little bit. I'm curious your take on it, but everything's more expensive in terms of materials and in terms of labor than it once was. Yeah,
I mean, especially in California, anywhere you have a non-right to work state, right? Wherever you have the unions, it's expensive. I think the work's phenomenal with unions, but it's expensive. Materials are way up. I mean, everything is. I feel like it's up. Inflation just across the board, right? So it's hard, and all that becomes part of the formula, right? So there's no easy answer there. It's if we're charged more, we got to charge more, and ultimately everybody hits some point of make it or break it point. You just got to find that point the best you can that works for everybody. And then when we structure leases for hospitals or physician groups, we give them every possible incentive we can. We finance those tenant improvements and leasing commissions wherever we can on a value add type deal. And we have a cheaper cost of capital than most people as a large institutional owner. So we try to pass that on to the tenants wherever we can, but it's tough.
Yeah, no question. And so where do you see, I guess the question I would ask is what keeps you up at night, and what do you think is the most important, if there is one, between now and the end of the year in terms of the overall economy? Is it interest rates? Is it employment? And is it cap rates? I mean, what is the one thing that you guys are watching in your office to keep a close eye on?
We're watching all of that, but I think the biggest thing is, you can only control what you can control. For us, that's basically underwriting. And I'm not worried about the healthcare business. It's just just like we all need a place to live, and there's not enough houses, so houses will go up in time, and rents will go up in time. So will medical use. We don't call it office anymore because office is a five-letter word, but outpatient space. So I think our biggest thing is just regulation and politics and global events, right? Bottom line is we all have to have healthcare, and we see things like COVID that happens, and hopefully we won't have anything like that for a while, but it still has to happen. Elective stuff gets delayed. Operational costs go up for a hospital. Reimbursements go down in a lot of cases. But, we over the last 3 recessions in the United States, you've seen healthcare sell through it, pretty spot free. And that's why we like the space. But we feel good about the space. It's just getting the sellers and the hospitals and the physician groups and just private owners of real estate to come to the conclusion that everybody has to earn a return going forward. That's the biggest thing. And we're already seeing things normalized. In 2020, end of 2022, and all of 2023, deals were, way down. And they're still way down, but we're seeing the expectations become more realistic, which is a good thing because ultimately this whole market depends on transactional volume, right?
Yeah, I would agree with that. I see more looks in terms of properties that are being peddled either on or off the market, and then it's just a question of being smart and making sure that you make good decisions when you are buying a property and that it's got good dynamics. I think at the end of the day, I really like the medical sector. I like it as much as I like the apartment sector because people need a place to live,
Me too.
and people are going to get sick and are going to need a doctor, and hopefully it's near their place where they live. So if you can buy an apartment building and a medical building next to each other, that's my suggestion for the day. So
Absolutely.
with that said, Paul's waving at me. We're closing in on our time limit. I do appreciate you coming on the show. If people want to find out more information about Healthcare Property Advisors, what's the website? Where can they go to check you out?
Yeah, we have a couple, but I would say HPA Exchange, HPA, the letter X, and then CHANGE.com, HPAExchange.com. That'll take you to the larger website. We're in the middle of redeveloping it now, but it's there. The basic stuff is there, and all the contact information is there. I'm also on LinkedIn.
Great. So, Rob, I really appreciate you coming on the show and sharing your thoughts and talking about the company and the market with us. And I wish you and your family and your company and your partners much continued success. And we'll look for some exciting things for the project up there in Brea and others that you have in the works. So thanks again for being on the show. For those viewers and listeners out there, thanks again for tuning in, listening in. If it's Tuesday, we are talking real estate. I am Barry Saywitz, president of the Saywitz Company. I want to give a special thanks to everybody here at OC Talk Radio, as always, for making the show happen. And we will see you back here next week on Let's Talk Real Estate.
Thanks for having me.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.